key to the answer is diversification in averages. Let's walk through the steps. An RMBS issue is secured by a diversified portfolio of home loans. These home loans are diversified by many factors, including geography, by loan balance, dwelling type, LVR, and also, and most importantly, interest rates. Not everyone pays the same interest rate. Yes, a pool may include borrowers paying 2%, but they also have borrowers paying 3% and even as high as high 3s or 4. So in a real life example of an RMBS transaction which Gryphon invested, the average interest rate was just over 3. So in this example, $1 billion diversified pool of home loans with an average LVR of 58%, meaning the market valuation of the homes mortgaged over the RMBS was circa $1.7 billion. The weighted average loan balance was $339,000, meaning the pool comprised of almost 3,000 home loans across Australia. To fund this $1 billion diversified pool of home loans, the bank issues $1 billion of RMBS bonds tranched into different credit ratings, from AAA and lower investment grade, which BBB and single A, to non-investment grade. The different credit ratings have different risk profiles. Different risk means different return profiles. The highest rated bonds are rated AAA, and almost 95% or 950 million of the billion are rated AAA. These AAA rated RMBS bonds are purchased by large international investors, and due to their very low risk, only return low returns, in this case just over 1%. The non-AAA rated RMBS bonds have slightly higher levels of risk, hence earn higher returns. Remembering each non-AAA rated RMBS invested in by Gryphon must pass our robust filters and stress testing, ensuring each and every position is loss remote. GCI invests in non-AAA rated bonds from AA down to non-investment grade, with the majority of GCI's portfolio rated investment grade. But remember, in this example, out of the $1 billion of RMBS bonds issued, there is only 50 million of non-AAA bonds. So while the bank is paying higher returns on these non-AAA rated bonds, almost 4% yield on the investment grade BBB rated bonds, the bank's cost of funding is driven by the cost of funding for the large AAA rated bonds at the very cheap 1%. So the average cost of funding for the bank is only a very low 1.15%. So how do the maths work? The bank earns on average 3% interest on the home loans. The bank pays bond investors a weighted average interest rate of circa 1.15%. The bank has other costs, including servicing of the loans, etc. So the all-in cost for the bank is around 2%. So the bank earns the mortgage interest rate of 3% and pays away the total cost of funding, circa 2%, with the difference being the bank's profit or excess spread. GCI invests in non-AAA rated bonds, receiving the higher returns. GCI has invested in a portfolio of over 90 RMBS and ABS bonds, each loss remote with different credit ratings and different return profiles, from less than 3% to over 7%. But the average investment return means GCI is able to meet its target return.